There were £140 billion worth of bids for £14 billion worth of 10-year gilts that were sold. That's not a market in trouble. That's overwhelming demand for UK government debt. Every week, the media tells us Britain is broken, on the brink of collapse. But the truth is very different. Britain was the fastest growing G7 economy. Markets are they exhibit all sorts of lemming-like behaviour at times. And I think there's an element of that going on right now. That is another symptom of this sort of mini financial hissy fit that I think is going on globally.
Welcome to this week's W4.0 Roundup of the Week. My name's John, and with me, as always, is Neil Woodford. This week, global markets have been rocked by three big shocks. Bond yields at multi-decade highs, sharp sector moves in the UK, and diverging performance across Asia. Over the next 30 minutes, we'll break down what's happened, what the market's really pricing in, and what it could mean for investors. Neil, let's start with the biggest story, which is the bond market rout. This week, bond yields spiked across the globe. In the UK, 30-year Gilts hit 5.75%, the highest since 1998. 30-year US Treasuries touched 5%, and Japan's long bond rose to a record 3.26%. And those moves have rattled equities and currencies everywhere. Firstly, Neil, are the bond markets reacting appropriately? And when markets react this way, what exactly are they imputing?
Well, this is a big subject, and there'll be lots of differing views. The consensus view is that bond markets everywhere are sending alarm signals to governments about the scale of public sector deficits. And if that were true, I think I would be genuinely concerned. But my views are quite different, and let me try and explain why I hold a different view from the one you may have read, and frankly, the one that you just outlined, John, because what you've reflected to me just now in that question, I think is a sort of consensual, sort of alarmist view that there's something significant going on in global bond markets. First of all, what's been going on tends to be focused in the longer end of these government bond markets. So ultra long gilt yields, for example. So the 30-year gilt yield has risen to, as you say, I think it reached 5.7% this week, which was the highest yield since 1998. This is being imputed as some sort of significant or symptomatic of a buyer's strike, and as you said, the bond yield, the long bond yield in Japan did the same, and indeed the French long yield is significantly higher than 10-year yields, and it's the same in the US. I think there are some important issues. It is far from universally true that all movements in global bond markets or global equity markets have some sort of underlying economic sort of motivation. Markets are inherently noisy. All sorts of things go on day to day that have absolutely that are based on no fundamental change in economics or politics or anything significant or real. They are just the sort of the background noise that you see in financial markets all the time, and this is the product of the inherent complexity of markets. All of the many buyers and sellers of financial assets are motivated by different things, and trying to impute some sort of meaningful message from all those hundreds of thousands, millions of financial decisions made by all sorts of different people is often a foolish pursuit, in my view. Having said that, I don't really think that these long bond yield moves are communicating some sort of deep, meaningful concern about government deficits. If they were, they would not be restricted to the long end of the government bond market. They would be manifested in areas where governments are actually funding their deficits, issuing debt effectively. Now, the Bank of England, the head of the Bank of England, Bailey, said, I think yesterday, that the government isn't going to fund at all at the 30-year gilt. In fact, in a 10-year gilt auction this week, the 14 billion gilts that were on sale were oversubscribed by a factor of 10. There were 140 billion pounds worth of bids for 14 billion pounds worth of 10-year gilts that were sold by the Debt Management Office. Now that indicates to me the real environment that exists in the UK government debt market, which is that there's very buoyant demand for the gilts that the government is issuing. The idea that because the 30-year yield has gone up to 5.6 or 7% is symptomatic of some sort of impending debt crisis is, I think, just wrong. I think it's wrong with respect to Japan, albeit that I've never really understood quite how 250% debt to GDP was a fundable sort of level of debt. But nevertheless, nothing's changed in Japan, nothing's changed in the UK, nothing's changed dramatically in Europe either. If you're looking for an underlying sort of economic development that might explain why this has happened in long government bond markets, I think you could be looking forever. There isn't anything that's caused this. This is just a market move, and I don't think it's based on anything fundamental at all. Now, with respect to the UK, where I'm slightly better informed than I am about Japan, or indeed long yields in the EU. What is clear is that the demand, the historically high level of demand for very long dated government debt has diminished significantly because defined benefit pension schemes appear to have all of the very long term debt that they need, and they're not now buying more, or they may well be buying more, but not at the scale that they have been in recent years. That might be the only explanation for what's happened at the long end of the gilt market. But as I said, 10-year yields, although they have gone up across Europe recently, across the board, apart from in Switzerland, although 10-year yields have risen, they are now rallying. So 10-year yields in the UK are about 4.7%. They were 4.8 at the start of the week. They're now 4.7. They appear to be rallying today and indeed again yesterday. I don't think there's anything significant driving this, anything materially significant driving this. And as I've said, 140 billion pounds worth of bids for a 14-pound gilt auction tells you all you need to know about the underlying demand for UK government debt at the moment. So I'm not imputing anything significant into this at all. Lots of people are, but I'm struggling to see what the rationale is.
For the people that are imputing something, what is it that what are they assuming that this is telling them? Because they must be assuming something. They're shifting, or they're trading into this news. What is it telling them?
Yeah. Look, I think markets are sort of, they exhibit all sorts of lemming-like behaviour at times. And I think there's an element of that going on right now. Oh, there's something troubling about long gilts and long Japanese government debt and long French government debt. Therefore, let's sell a few. And these are not deeply liquid markets. Let's remember that. So a few sellers doing the same thing can have an impact, and a few sellers of long-dated government securities can have an impact on yields, and that sort of herd-like lemming behaviour can become infectious in gilt markets just as it can in equity markets. Not all market moves can be rationalised, can be explained by underlying real economic, political, or other events. Sometimes they just are the result of some people doing the same thing at the same time in financial markets for no good reason. So what are they thinking was the question. Sorry, John. So the question you asked, what are they thinking? I think it's hard to know exactly what the people who've sold are thinking. I can't populate their brains. But what I impute is that there is some concern that government deficits around the world are too large, and that the requirement to fund these deficits will mean additional strain on debt markets, and investors will require a higher yield to want to buy, if you like, long dated government debt. That's sort of how people are sort of mashing this together, which is interesting because, weirdly, whilst this sort of very long government debt sort of sell-off has been going on this week and now for some weeks in the UK, the 10-year yield in the US has fallen, interestingly. Not that long ago, 10-year yields in the US, the most important government bond market in the world, were at 4.5%, and they're now below 4.2%. And I think they're lower in the US than they were in June and in the middle of last month, because we've had weaker job data in the US, weaker than expected. And I think there is now a broad acceptance that the Fed will cut rates this month at the meeting in the middle of the month. So weirdly, amongst all of the sort of the crisis sort of talk that you've seen in the media about what's going on in long debt markets, the reality is that the 10-year yield in the US has fallen. Now, that's where the government will be funding its deficit, at 10-year yields and at shorter durations, not at the 30-year duration.
We've seen clearly some investors heading for real assets like gold, and gold, I think, has hit a record high this week as well. In your mind, is that related? Is that a sign of people seeking safe havens?
Yeah, it's a sort of safe haven default thing. Gold's gone up, so it will attract more buyers and sellers. And this, the sort of the rationale, if you like, the one that I've just the sort of woolly rationale that I've just described, that might have motivated people to sell long dated government debt, might also motivate them to seek a safe haven in gold as a real asset. I've never really understood the gold market in my career. Still don't really understand it, but I think I can see that is another symptom of this sort of mini financial sort of hissy fit that I think is going on globally.
Let's bring it back to the UK specifically, which I know is your specialist subject. We've seen house builders, retailers, utilities slide this week, whilst miners and healthcare stocks have rallied slightly. What exactly is the market assuming in those sectors? Do you agree with them?
Not especially. No, I think what's the UK market is up 20% from the lows that it reached in early April on the back of the Trump tariff announcement. That's a very decent gain that we've seen from that low point earlier this year. When the market's risen that much and relatively quickly, clearly there are profits to be had. So I just think that what you've seen this week, certainly in the financials, which have sold off, I think there was a sort of a broad spread sell-off earlier in the week across domestic issues. I think that was sort of symptomatic of a bit of profit taking, and also this widespread sort of UK media view that the UK is sort of headed to, is going to hell in a handcart. I mean, the economy is going to hell in a handcart. Earlier this week, there was, I think it might have been last week, there was quite a well-publicised article in the Daily Telegraph about the fact that the UK could need an IMF bailout. I think it's total rubbish. It's just hysterical nonsense. But nevertheless, that media story has gathered or has attracted other media attention. You know, the financial media are universally negative and bearish about the UK economy. It's wrong, fundamentally, profoundly, obviously wrong, in my view. But nevertheless, I think that the combination of sort of media hysteria, what's going on in long bonds, and a few more articles about how awful everything is, may just have prompted some people to take profits in the equity market.
So thinking about the house builders sector, I assume the market is thinking, or people buying or selling in that sector are thinking that higher mortgage rates will choke demand for housing markets and therefore reduce sales volumes. Do you agree with that assessment? Is that something that's likely to happen?
No, I think that rationale is just factually wrong. As you may well know, the mortgage market in the UK is characterised typically by 5-year fixed rates and 2-year fixed rates. So the 30-year bond yield is totally and utterly irrelevant to the UK mortgage market. What's actually been happening, the real picture, is that the mortgage market is picking up. There is now growth in lending from the lows that were plumbed last year. There's now about 3% plus growth in mortgage lending. New mortgage approvals are growing. There are tentative signs that the market is picking up. And that's what I believe we will see more evidence of as we go forward. Lower interest rates are going to stimulate more activity in the UK housing market. And I think it'll also stimulate growth in new house building too. So the reality is that the slightly lower rates that we've seen at those maturities, 2 and 5 year maturities, will result in growth in a recovery in the mortgage market and mortgage lending. We're seeing that. I've written about that recently. The 30-year gilt yield is totally irrelevant to the UK housing market.
Do you think those moves were fair, or was that a sign of the market overreacting?
I just think it's overreaction. I just think it's part and parcel of the natural sort of background volatility, the background noisiness that equity markets exhibit. I don't think there's anything really meaningful in that sell-off, and indeed, today the market's being led by the very same stocks that were leading it down earlier in the week. So yeah, this is just what you expect. You know, I've been sort of watching closely, the UK equity market now for longer than I care to remember, and this is just part and parcel of the sort of the noisiness that you witness all the time in the equity market. And I think investors need to understand that they need to look through this. They should not impute meaning or fundamentally important implications from market noise. It's just the hysterical ramblings of very complex, very sort of arcane financial markets. I mean, the point is the motivations of all the people who have bought and sold this week are very, very different. Some will be motivated to follow what happens in the stock market. Others will be motivated by their impending retirement. Others will be motivated by the desire to buy stocks because they come down a bit. These are inherently complex, noisy markets, and this is just part and parcel of the everyday volatility that's always been a part of this financial market.
So really, nothing's changed.
No, nothing's changed.
Let's talk about China, where it's been a very different week and quite interesting. Give me the short summary of what's happened this week in China.
This week, Chinese equities have been pretty strong, and it follows an incredibly good August for China's equity markets, both in Hong Kong and in mainland China. And it caps off, what's been a good year for financial assets, well, particularly for equities in China. There are a number of things that are sort of exciting interest in China. I think the fact is that it's rallying off an incredibly low point. So if we go back a little bit, in the middle of last year, China was at multi-year lows. The Chinese equity market was at multi-year lows. Investor sentiment was very depressed. People like Goldman Sachs were saying that China is uninvestable. People were walking away from China as an investable market. And then I think in about September, about a year ago, the Chinese authorities, I think, woke up, recognized that the very low level that the equity market had reached was troubling, and that they needed to do something. So they intervened with a number of stimulus measures, some of which were directly focused at stimulating interest in the Chinese equity market, and that worked. There was a very strong rally. in September last year. Incredible rally, really. Now that sort of slightly subsided over the next over the next 6 months. And that was partly, I think, because Chinese investors were becoming increasingly worried about what a new Trump presidency would mean for China, for trade. And of course, that culminated in the sell-off in April when Trump announced his initial sort of Liberation Day tariffs. Now, the equity market retraced more than half of that rally that it had seen in the previous September on the back of that sort of concern. But from April onwards, China has rallied very strongly, largely because I think, first of all, I think international investors have recognized, first of all, that China is a very cheap equity market. I think there's a lot more interest in Chinese technology companies, and the DeepSeek announcement earlier in the year was, I think, a bit of a wake-up call for global investors. You know, China has some incredibly good technology in AI in particular, and I think people were attracted to invest in Chinese technology companies as a result of that. So, of course, the trade tension, which was at a very high level early in April this year, has abated significantly since then. So, there's now a pretty much broad-based truce between China and the US on tariffs, and there is rumored to be a sort of President Xi, President Trump summit that may well take place in October or November, at which it would appear that some grand trade deal will be done. That's the hope, and that's my expectation and hope. So I think that improving sentiment has also been reflected in this rally we've seen from the lows in April. But August has been a very good month, and I think this has been driven by a little bit of a sort of speculative frenzy in Chinese IPOs, particularly tech and AI related IPOs. They've been very, very good, very strong. And I think the Chinese authorities are getting a little bit concerned that the markets might be getting a bit frothy. So they've announced overnight a number of measures to slightly calm the market. That seemingly worked a little bit because the market's down 2% overnight. And that's taken a little bit of that sort of heat that was building up in the equity market in China. Has taken the heat out of that market. Fundamentally, I still think there are lots of really interesting and exciting opportunities in the Chinese tech sector where valuations are still very low, albeit not as low as they were a year ago, but they're still too low in my view. But you've seen some areas of the Chinese equity market do very well in recent months. Solar stocks in particular have done really well. Not the manufacturers, but some of the other solar stocks have done very well. And there are sort of pockets of sort of exuberance, I would put it, no more than that. So I think that slightly concerned the Chinese authorities. They've stepped in, calmed the market down. But I think fundamentally, there are lots of attractive opportunities in the technology sector that still look very, very undervalued.
What should investors, in your mind, take away from a week like this?
I think this week's been an important lesson, really, for those people who are really focused on the long term, which is, as Warren Buffett says, as lots of the world's greatest investors say, don't be distracted by short-term noisy markets, focus on long-term goals, and respond to valuation triggers only.
Thank you, Neil. Now, just before we go, we've had a couple of questions from listeners to the podcast. Chris wanted to know, how do you think Prime Minister Keir Starmer has handled Trump and the EU so far in terms of trade and tariff deals?
Look, I think Trump is well disposed towards the UK. He likes the UK. Obviously, we know he loves golf. He owns a number of courses particularly in Scotland. Look, he's well disposed towards the UK. I think he was well disposed to doing a trade deal with the UK, and he appears to have a good relationship with Keir Starmer. So those two things have worked, I think, well. So the fact that the UK has a very privileged position in a way with respect to trade with the US is a very good thing. I think it is something that lots of people in the media don't want to talk about, because, of course, if we were still in the EU, we would be part and parcel of the EU's trade deal with the US, which is not as advantaged, or nowhere near as advantaged, as the UK's deal is. So that's important to reflect upon. Quite whether that is down to Keir Starmer's negotiating skill or not, I'm not quite sure. I frankly doubt it. But nevertheless, it's a good outcome, and we should applaud it. As for the EU, it would appear that that some of the trading impediments that existed between the EU and the UK post the EU's post Brexit have been eased in recent months. So again, that I would say tick in the box. What's more important, though, for the UK equity market going forward, I think, is getting the right policy mix for the UK economy. That's what I will judge this administration by. I'm not here really to comment on the politics, but I'm much more focused for this podcast on the economic policy. And as everybody who's heard what I've said hitherto will know, I am not a fan of the tax and spend policies, fundamental economic policies that this government has embraced. I think they're wrong. I think they're failing. I think they need to change course. Whether they will or not, I'm not sure. But the fact is that the UK economy will, in my view, continue to outperform consensus expectations, despite having a government which is not particularly helping, or a government's economic strategy which is not particularly helping.
And the second question is from Julian, who writes in to say that while interest rates have clearly weighed on house builders to date, he wonders if there's something more fundamental going on, with potential tax rises, consumer uncertainty, and even reports from builders on the ground that workloads are drying up and builders' yards are beginning to cut staff. And he wants to know whether you think this points to a wider slowdown in the building trade beyond the immediate impact of rates.
This is a good question. It reflects, I think, what the questioner may well have read in the media. The reality is that housing completions are beginning to recover from a very depressed level. The housing market has been in a sort of 3-year recession since the war kicked off in Ukraine in February 2022, and interest rates and inflation went through the roof. The reality is that housing affordability is improving, reflected by lower two-year fixed rates and lower 5-year fixed rates. And we're seeing that come through in mortgage approvals. We're seeing it come through in growth in mortgage lending. Now, it's early stage. I want to see more of that come through, and I think we will, as interest rates continue to fall, as inflation continues to fall in the UK. So the next 12 to 18 months, I think we'll see a more sustained, more significant recovery in the UK housing market, largely as interest rates continue to fall and affordability improves. There is, however, one thing that the government could do literally overnight that would help to transform the prospects of the UK housing market. And that will be to introduce effectively a mortgage guarantee scheme for 100% loan-to-value mortgages. If the government said, we will guarantee all 100% loan-to-value mortgages on new build and on second-hand homes, that would transform the mortgage market, because it would significantly improve the mortgage availability. At the moment, banks can't really lend 100% loan-to-value mortgages because they are very capital-intensive mortgages, and so they can't make money lending 100% loan-to-value mortgages. So there aren't any that are available in the UK, and as a result of that, first-time buyers have to save a deposit. Now, some lucky house buyers can borrow that money from their parents or from other friends and family. But the fact is that for most people, getting that deposit, that 10, 15, 20% deposit is very, very challenging. If consumers could get 100% loan-to-value mortgages that were guaranteed by the UK government, the banks would lend, they wouldn't have the capital intensity, that would transform the mortgage market, and it could happen literally overnight. Now, would this be a good idea? Frankly, I think it would be a very, very good idea. I think there will be little risk in the government underwriting 100% loan-to-value mortgages, and that's because house prices in real terms are down significantly on where they were 10 years ago. In nominal terms, house prices are about the same level. Real terms, they're down significantly. The average house price in the UK is, well, according to the Nationwide, is about just over £270,000. I don't think that is extraordinarily high at all. And frankly, for most people, buying a house at that level, in my view, would be a sensible financial decision. And it would be a sensible financial decision for the government to underwrite those mortgages, because I can't see really any prospect of them losing money or having to step up and take a hit on those mortgage guarantees over a 10 or 15 or 20-year period.
Clear and direct, as always. Neil, thank you so much for your time. It's always a pleasure listening to you.
Thank you, John, and thank you to all our listeners as well.
If you found this useful, if you found this episode useful, make sure you follow W4.0 on social media. And we're posting more of Neil's analysis throughout the week on all of those social channels. We'll, of course, be back next week. But until then, thank you once again and take care.